Welcome to the Opening Bell Report.
So if you were watching the trading screen on January 14th, 2026, you probably saw a pretty harsh reality check for CETX Inc. That's ticker CETX.
Oh, yeah.
The stock closed down at $2.31, a drop of 7.6%.
Ouch.
It is an ouch. And, your first instinct when you see that, a drop that sharp, is that something is fundamentally broken with the company.
Exactly. You think, okay, major headwind, something's wrong here. But the analysis we're digging into today, it presents a completely different view, a really wild, contrarian take.
It really does. I mean, this report we're looking at calls that exact moment of panic, that 7.6% drop, a gift.
A gift.
Yeah. The core argument is that this isn't weakness. It's actually a screaming buy signal for anyone who can look past that short-term noise and see this massive structural transformation that's happening.
So that's our mission today. We want to unpack this extreme dislocation. This analysis claims the market is ignoring a huge corporate pivot, so significant that the current stock price is basically irrational. It's a gap between price and what's actually happening, and the report believes that gap is, inevitably going to close.
It's classic market inertia, it sounds like.
That's exactly it. The stock is being valued based on what CETX used to be, not what the audited results and their recent strategic moves say it is now.
Okay, let's unpack this. What is the single biggest factor driving this gulf between the $2 price and the company's true value, according to this analysis report?
Well, it all starts with the biggest misconception. The market is still pricing CETX like it's just this struggling industrial company.
And that's outdated.
Completely, because the company has officially pivoted into the high-margin, very stable defense sector.
And this isn't just a press release about some future plan, right? This has actually happened.
It's an accomplished fact. The key date here was January 8th, 2026. That's when CETX completed its acquisition of Invocon, Inc. That move formally launched their brand new aerospace and defense segment.
Okay, so Invocon is the engine of the change. But why them specifically? I mean, doesn't it take years to get the clearances and build the relationships to be a real defense contractor?
It absolutely does. And that's the genius of the acquisition, according to this analysis. Invocon isn't some startup trying to break in.
Right.
They're a deeply established, profitable engineering firm with a 40-year history. They already have the security clearances, the track record, and most importantly, the clients.
So they didn't build it, they bought it. They bought instant credibility.
Precisely. Instant credibility and stability. And you can actually quantify that stability. They hold mission-critical contracts with some huge entities, including the Missile Defense Agency.
Wow.
And the report specifically calls out their role in the massive SHIELD IDQ contract.
IDQs. That's a lot of letters.
Yeah.
For anyone listening, what does SHIELD IDQ actually mean for the company's bottom line?
Right. That's where this idea of revenue stickiness comes in. IDIQ stands for indefinite delivery, indefinite quantity. It's a very desirable type of government contract. It basically means the government has pre-qualified Invocon for a long time, maybe 5 or 10 years, to work on tasks under a huge spending ceiling. It's not a one-off job. It's a pipeline.
So it's predictable, recurring revenue.
Exactly.
Yeah.
It's the kind of long-term commitment that high multiple defense contractors are prized for. It completely changes the risk profile of the company.
So the implication here, the gift, is that you're getting exposure to these high-margin, sticky government contracts, but you're buying it at a penny stock valuation.
That's the core argument. What's fascinating here is the reason for the mispricing. The market lags. Algorithms and big institutions still screen CETX as this low multiple industrial stock. It takes time for that perception to change.
The structural shift is definitely compelling. But, the next question a skeptic would ask is, fine, but can the old business even support this new one? Which brings us to the financials.
And that directly tackles the historical barricade.
Which was
that CETX was just a cash incinerator. They couldn't turn a profit on the industrial side. But the analysis just points to the fiscal year 2025 results that came out on December 29th. These are audited figures, not projections.
Okay, so let's break down the evidence. What does the report show about the company's performance before Invocon's revenue even hits the books?
Well, first, the growth is solid. Revenue hit $76.5 million. That's a 14% increase year over year.
So the legacy business is still growing.
It is. And more importantly, it's getting more profitable. Gross margin expanded to 42%. For an industrial tech company, that is excellent. It shows they're managing their costs really well.
But the real number, the one that the report says dismantles the whole bear argument, is operating income, right?
That's the one. Yeah. The company flipped to a positive $0.5 million in operating income for the year.
And just to clarify for everyone, why is operating income the key metric here? more so than, say, net income?
It's a great question. Because operating income shows you the profit from the core business itself before you factor in things like interest or taxes or one-time costs. It tells you if the fundamental business model actually works.
If it's self-sustaining.
Right. And you have to contrast that $500,000 profit with the previous year. In fiscal year 2024, they had a $5.3 million operating loss.
Whoa. So wait, a $5.3 million loss to a $0.5 million profit. That's a $5.8 million positive swing in 1 year.
It's a massive swing. It's undeniable operational improvement. And this is all happening before the high-margin defense revenue from InvoCon even starts to show up.
Here's where it gets really interesting. The market is ignoring actual published financial reality.
That's what the analysis claims. The fundamental story that the stock price is telling you, that this is a struggling company, is directly contradicted by its own audited financials.
So if the financials are turning around and they bolted on a defense contractor, let's talk about the valuation. The report says the 231 price point defies logic.
The numbers are pretty stark. You look at the price-to-sales ratio, the PS ratio.
A measure of the stock price relative to its annual revenue.
Right. At that closing price, the company is trading at a PS ratio of only about 0.3x.
Let's make that tangible. A 0.3x PS means for every $1 of sales the company makes, the market is valuing that dollar at just 30 cents.
Yes. It's an extreme discount. And when you put it next to its peers, the gap is just colossal.
So what should a company like this be trading at? A growing industrial firm, now with a defense tech arm.
Well, context is everything here. A high-growth tech company or a stable defense stock. They typically trade for anywhere from 2x to 5x sales. Even a boring old industrial company might get 1x sales.
And CETX is at 0.3.
Pennies on the dollar relative to its revenue.
That suggests a huge potential upside. So what's the risk? Why hasn't this gap closed?
That's the high-risk part of the high-reward thesis. The risk is that the market just keeps ignoring it, that the sentiment can lag behind the fundamentals for an uncomfortable long time.
The story just doesn't get out.
Exactly, but the analysis says the math is just too compelling. Analyst targets are way higher, some models are pointing toward $11 or more, but even if you simplify it, if the stock just got back to a 1x PS multiple,
And it's still cheap.
still very cheap for this kind of company, the share price would have to triple from where it is now.
Wow.
If we connect this to the bigger picture, the current valuation doesn't just say the company is cheap. A 0.3 XPS ratio implies bankruptcy is on the horizon.
A total collapse.
Right. It's a valuation for a company you expect to fail. And yet the facts show a company that just hit positive operating income and bought a profitable defense contractor. The price just doesn't compute.
Okay, so beyond the fundamentals, the report also touches on some technical indicators that support this buy the fear idea.
It does, yeah. The technical setup sort of adds another layer. That 7.6% drop pushed the stock right down to the $2.10 level. And that level is the 52-week low. It's acted as a pretty significant floor in the past.
A line in the sand where buyers have shown up before.
Exactly. The analysis notes that's where value buyers have historically stepped in.
And the nature of the drop itself, how fast and sharp it was, that's important too.
Very important. A sharp fall like that pushed the stock deep into what's called oversold territory on the Relative Strength Index, or RSI.
So the RSI measures the speed of price changes.
Right. And when it falls that fast, it suggests the move was driven more by panic and herd mentality than by, thoughtful analysis. That kind of setup increases the probability of a sharp corrective bounce.
So you have a potential short-term technical bounce on top of the long-term fundamental story.
That's the idea.
Okay, let's bring this all home for our listener. We have a huge structural shift, we have a validated financial turnaround, and an oversold technical setup. What's the final synthesis from this report?
The conclusion is very firm. The drop to 231 was driven by sentiment and fear, not by the company's actual performance. When you strip all that away, you're left with a company that has growing revenue, positive operating income, and a new, stable defense division, all trading at a market cap of around $20 million.
It's just a massive discount. So the verdict presented in the source material is what? Strong buy?
Strong buy, high risk, high reward. And it ends with that famous quote, that timeless contrarian idea.
Be greedy when others are fearful.
That's the one. It really defines the entire investment philosophy here.
That brings us to the end of this deep dive. The market seems to be offering a defense and industrial growth story at a valuation that's usually saved for companies facing, an existential crisis.
And so the key now is to watch for the catalyst that forces the market to reprice everything. The analysis suggests the next big milestone is the quarterly earnings release in February 2026.
Because that will be the first report with InvoCon's revenue included.
Exactly. It's the first chance for management to show the full financial strength of the combined company.
So what does this all mean? Well, based on this analysis, you have to ask yourself, How long can a disconnect between a tangible $5.8 million profit swing and a bankruptcy valuation really last? How long can the market ignore a fundamental shift like this before it's forced to reprice the risk and the reward?
Don't forget to like, share, and subscribe for more.